Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good.
So today's deep dive is all about redefining this idea of a safe asset for the everyday investor right now in 2026. Because based on recent analysis, the traditional textbook rules of investing, they've kind of been turned upside down this year.
Yeah, completely flipped on their head, honestly.
Right. So if you've been relying on the old rules to protect your money, you might be in for a rude awakening. We really want to equip you with the tools to protect your portfolio so you don't get caught off guard.
Because the environment we are in right now is just, it's totally unique. We're seeing this massive collision of macroeconomic forces all happening at the exact same time.
Like what, specifically?
Well, you have the Trump administration's tariff policies shifting global trade, right? And then you combine that with really large U.S. fiscal deficits, plus all the ongoing geopolitical tensions in the Middle East.
Right. It's a lot all at once.
It is. And when you mix those specific variables together, the very concept of safety in the financial markets fundamentally changes. The old safe havens just stop working the way they're supposed to.
Okay, I want to jump in right here just to make something super clear for everyone listening. When we talk about the current administration's tariff policies or the size of the national deficit, we are purely looking at market mechanics based on the research.
Exactly, yeah. Just the data.
Right. We are not taking a political side, and we aren't endorsing any viewpoint on whether these policies are, good or bad for the country. We are just impartially reporting on how the global financial markets are reacting to these risks based on recent analysis.
And that's such an important baseline to set because the market, it doesn't have political opinions. It's just an unemotional calculating machine.
Right. It just looks at the numbers.
Exactly. And historically, that calculation was really simple. If the stock market, like the S&P 500, took a dive, investors would just blindly buy U.S. Treasuries, gold, or the U.S. dollar. That was the rule.
The ultimate safety net.
Right. But looking at the data for 2026, that formula has actually failed multiple times.
So to make this relatable, think of a safe asset like bringing an umbrella to protect against bad weather. Like if it rains, you pop the umbrella, you're safe.
Great analogy, yeah.
But what if the bad weather isn't rain? What if it's a hurricane or like a massive heat wave? An umbrella won't save you from a heat wave.
No, it won't. It might even make it worse. And that's exactly what the data shows happened between May and July of this year.
What happened then?
Well, Middle East tensions flared up, right? So oil prices spiked. Normally, the textbook says, war leads to recession, so buy U.S. Treasuries.
Because bonds are safe.
Right. But instead, Treasuries actually weakened. The market didn't play the recession playbook. It played a totally different logic.
Which was what?
It went, war leads to higher oil prices, which leads to inflation, which means higher interest rates. So the bonds dropped.
Wow. So based on this research, a safe asset isn't just an absolute universal thing anymore. It's strictly context dependent.
100% context dependent, yes.
Okay, since we just established that the umbrella doesn't always work, let's look at the biggest umbrella of them all, U.S. Treasuries. Why did they fail to protect investors recently?
So government bonds are fantastic, but they have a very specific use case. They are the ultimate defense against a recession.
Like 2008 or the start of COVID.
Exactly. During a recession, the economy stalls, so the central bank cuts interest rates to stimulate growth. And when interest rates go down, the prices of the bonds you already hold go up.
Right, because your older bond pays a higher rate than the new ones.
Yes, exactly. But, and this is the crucial part, bonds are terrible defenses against inflation.
Okay, and why is that?
Because if inflation is high, the Federal Reserve can't cut rates. In fact, looking at the 2026 data, the market is super concerned that the U.S. fiscal deficit and those tariff policies are going to fuel long-term inflation.
Wait, so if my stocks are crashing because of inflation, and I bought bonds to protect myself, am I basically getting punched in both arms at the same time?
That's exactly what's happening, punched in both arms.
Oh.
Right. And we saw this in the data. A recent Reuters analysis looked at a 60-day period this year, and the correlation between the S&P 500 and Treasury yields hit its highest level in over 20 years.
Meaning they were moving together.
Exactly. Stocks went down and bonds went down right alongside them. Treasuries did not automatically defend portfolios when inflation was the primary fear.
Okay, well, if bonds aren't a foolproof shield against inflation, I feel like the next logical thought for anyone listening is, what about gold? I mean, it's literally the oldest safe haven in human history, right?
It is. And gold is historically very strong against geopolitical risks, or when central banks are buying it up, or if currency is being devalued.
Right.
But gold has a massive Achilles heel, and that is real interest rates.
Okay, I think I have another everyday analogy for this. Tell me if this tracks. Gold is kind of like owning a beautiful classic car.
Okay, I like where this is going.
Like, it holds its value, it looks great in the garage, but it doesn't pay you a dividend, it doesn't yield any interest.
Zero yield. Exactly.
So if your boring old savings account suddenly starts paying massive interest rates, people are going to ditch the classic car to grab the easy, risk-free cash.
That is a perfect analogy, yes, because holding gold actually costs you the opportunity to make that high interest in the bank.
Right.
And we saw this exact dynamic play out. The Wall Street Journal highlighted a great example from earlier this year. During those initial Middle East tensions, gold actually weakened while oil and the U.S. dollar surged.
Because the market thought those tensions would cause inflation, which would keep interest rates high.
You got it. But the moment U.S. CPI, the inflation data, came in lower than expected, the narrative completely flipped.
Because lower inflation means interest rates might fall. The savings account isn't paying out as much anymore.
Exactly. And the second that data dropped, gold instantly spiked over 1.6% in a single day.
Wow. In one day.
Just one day. So gold cares deeply about interest rates. You can't just buy it blindly and expect it to always go up when things look bad.
Right. So if gold is too sensitive to interest rates, the listener's next logical refuge is probably the U.S. dollar, right? I mean, it's the world's reserve currency.
It is, and in most global crises, the dollar is absolute king. It represents pure liquidity.
Meaning you can instantly trade it for whatever you need.
Exactly. According to Reuters, the dollar acted perfectly as a safe haven during those geopolitical flare-ups in July. Everyone wanted dollars.
But there's an exception to this rule too, isn't there?
Yes, a big one. Based on the analysis, the dollar weakens when the risk originates inside the United States.
Okay. Let me frame this for the listeners. So, buying the dollar during a global crisis is like hiding in your basement during a tornado. It's obviously the safest place to be.
Right.
But if the crisis is caused by U.S. fiscal policy, it's like hiding in the basement when the basement itself is on fire.
That's exactly it. If the U.S. is the source of the fire, the dollar won't protect you. Earlier in the year, the stock market dropped specifically because of concerns over U.S. tariff policies and fiscal soundness.
The basement was on fire.
Yes. And during that drop, the dollar actually weakened alongside stocks. Investors had to look elsewhere for safety.
Okay, so we've basically debunked the absolute safety of bonds, gold, and the dollar. They all have major blind spots. So how do financial professionals actually view this? Like, is everyone in agreement that the old rules are dead?
Well, the institutional consensus is definitely shifting. Major global asset managers like Morgan Stanley and State Street completely agree that the era of a single safe asset is ending.
They're changing their tune.
Yeah, Morgan Stanley actually calls safety context-specific now, and State Street has been actively warning about gold's short-term volatility.
But wait, to be fair and provide a balanced view, not everyone is on board with this new reality, right? There has to be a counter-argument.
Oh, for sure. There's a strong camp of investors who firmly believe this correlation shift is just temporary.
Like a post-pandemic hangover or something.
Exactly. They argue that the U.S. dollar and Treasuries are just too deeply woven into the global system to ever lose their reserve status long term.
So they think if a massive traditional recession hits, Treasuries will instantly recover their classic hedging power.
Right. They believe the old textbook will work again. And impartially speaking, that is a completely valid perspective to keep in mind. Over a 20-year horizon, they might be right.
But for the listener trying to manage their money today, how do they actually apply all this complex macroeconomic theory? Like, how do I apply this to my retirement account?
It all comes down to diagnosing the problem before you treat it.
This is what we call the bottleneck concept. The core rule here is stop asking, what should I buy when stocks fall? And start asking, why are stocks falling? Diagnosing the disease comes before prescribing the medicine.
Exactly. So, based on the research, here is your rapid-fire cheat sheet for 2026.
Okay, let's hear it.
If stocks fall due to a recession, Treasuries are your best bet.
Makes sense. What if stocks fall due to inflation?
Then commodities and real assets might be better.
And geopolitics.
The dollar and gold lead the way.
But what if stocks fall due to U.S. fiscal instability? Like the basement on fire?
Then gold beats the dollar.
Okay, and what if it's just a long-term bear market? Just a slow, grinding drop?
That's when trend-following strategies become crucial, basically using algorithms to ride the market momentum rather than betting on specific economic outcomes.
Wow, okay. That is a lot to juggle.
It is, which is why portfolio strategy today requires three things. First, you need a multi-axis defense, a real mix of assets.
You can't just hold one umbrella.
Right. Second, you cannot blindly trust the correlations of the last 20 years.
The 60/40 portfolio isn't magic anymore.
Exactly. And third, you have to actively rebalance your defensive assets as the macroeconomic environment shifts. You have to stay engaged.
So you really have to look under the hood of what's happening.
Yeah, the set it and forget it days are getting a lot harder to rely on.
Right. Well, before we wrap up, I want to leave you, the listener, with something deep to ponder on your own.
Well, I like a good thought experiment.
Yeah. So we've just established that the relationship between stocks and bonds can completely flip, depending on whether the market fears a recession or if it fears inflation.
Right.
So,
The old punch in both arms scenario.
exactly. So what does that mean for the millions of Americans holding traditional set it and forget it, target date retirement funds?
Oh, wow. That's a huge question.
Because those automated portfolios are hard-coded to just buy more bonds as you get older, assuming they're always safe.
Hmm?
Are those automated funds truly prepared for a world where the old textbook rules no longer apply?
Yeah, that's pretty wild to think about. A lot of people are relying on autopilot right now.
Yeah. It's definitely a fascinating question to consider as you review your own investment and, think about what's actually under the hood of your retirement account.
Absolutely.
Well, that is all for today's deep dive. Don't forget to subscribe and hit that like button.